Okay, let's unpack this, because if you want to know what the S&P 500 is going to do tomorrow, you honestly shouldn't just stare at a candlestick chart.
Right. No, you really shouldn't.
Yeah, you should actually look at a massive pile of discarded crock pots and, like, children's toys in a New Jersey bin store.
Which sounds completely ridiculous, I know, but it is so true.
It really is. So, welcome to today's deep dive. We have an incredible stack of sources today. I mean, we are pulling from raw transcripts of live day trading sessions, institutional macro strategy memos, and this really fascinating on-the-ground consumer behavioral data.
Yeah, it's a very diverse mix this time.
It is, because right now, the pristine lines on our trading screens, they're masking a very messy, really rapid rewiring of the global economy.
Absolutely.
And our mission today is to figure out the wild price anomalies hitting the tech sector and obviously the sudden surges in crypto. But to do that, we first have to understand the foundational shifts in where money is actually flowing out in the real world.
Yeah, and I think, it really comes down to the underlying mechanisms of corporate revenue. Because we tend to separate the market from the economy in our heads, right? We treat them as two totally different ecosystems.
Oh, for sure. Wall Street versus Main Street.
Exactly. But every single structure is ultimately just a measurement of consumer demand intersecting with corporate efficiency. You simply cannot parse today's technical trading levels without first dissecting the really severe structural shifts happening right at the cash register.
Right, which perfectly brings us to Sharon's bin store in Trenton, New Jersey.
Yes. Such a great example.
It's fascinating. So she opened this place in February 2020, right on Valentine's Day. And the premise of her store is just wild. Major retailers have these massive boxes of returned goods, but instead of restocking them, corporations are essentially they're just writing them off.
Yeah, they just abandon them.
Right. So Sharon buys these massive pallets of supposedly dead inventory. She dumps the items onto 12 tables, and she sells literally everything for a flat $5.
And the mechanism behind this, it highlights a genuinely grotesque inefficiency in modern supply chains.
How so?
Well, it's an industry term called reverse logistics.
Yeah.
So think about when you return a blender to a major retailer, the corporation has to pay for the return shipping.
Okay.
Then they have to pay for the labor to inspect the item, the labor to repackage it, and, the warehousing space to store it.
Right, which is not cheap.
No, it's incredibly expensive. So the margins on that blender are often entirely wiped out by the logistical friction of the return process itself. It literally becomes a toxic asset on their balance sheet.
Wait, so financially, it is literally cheaper for a multi-billion-dollar corporation to just sell perfectly good inventory by the ton to liquidators, or even dump it in a landfill.
Yes. Yes, rather than putting it back on a shelf, it is cheaper to get rid of it.
Wow. That is that's crazy. But okay, if these corporations are so incredibly inefficient, why does Sharon's store matter to the broader macro picture? Is an algorithmic trading bot on Wall Street really factoring in a discounted crock pot in Trenton?
Well, not directly, no. But the algorithm is factoring in what Sharon's customer base represents, because in her interview, she noted a really major demographic shift.
Oh, right, the inflation impact.
Exactly. When inflation really started biting, her customers weren't just, low-income families looking for a break. She started seeing people from seemingly well-to-do financial backgrounds flocking to these bins.
Yeah, I noticed that in the notes. She said people you'd assume are upper middle class are just walking through those doors because they're secretly living paycheck to paycheck.
And that right there is the blinking red indicator for the broader market. It reveals this severe hollowing out of middle-class liquidity. When households that traditionally drive our discretionary spending are quietly relying on liquidator bins just to maintain their standard of living, you realize that consumer resilience is, it's fragile. The broader market has been pricing in that resilience as a permanent fixture, but it's actually a mirage built on credit and depleted savings.
Wow. Okay, so if that is the silent squeeze on the consumer's wallet, the sources point to an equally aggressive squeeze happening to their daily habits.
Yeah, the health side of things.
Right. Let's look at the source material on Olipop, the functional beverage company founded by Ben Goodwin. They recently hit over $500 million in profitable revenue.
Which is staggering for a startup beverage brand.
It really is.
And, they accomplished that by exploiting a massive generational health vacuum. Because the USDA recommends 28 grams of fiber a day, but 90% of Americans are missing that mark completely.
90%. That's almost everybody.
Yeah. And then you couple that massive fiber deficit with our daily sugar intake, and nearly 50% of the country is either pre-diabetic or dealing with full-blown type 2 diabetes.
Which is just a staggering structural issue. And Goodwin's approach to this is frankly brilliant because he didn't build some medicinal supplement in a brown bottle. He built a delivery system disguised as nostalgia.
A Trojan horse.
Exactly. A can of Olipop delivers up to 9 grams of fiber, but it tastes like a classic sugary root beer. But here's my question with this. Companies like Coca-Cola and PepsiCo have billions, literally billions of dollars in R&D and marketing.
Oh yeah, massive war chests.
So how does an upstart beverage company steal $500 million in revenue right out from under them?
Well, because legacy brands are fighting a demographic headwind that marketing dollars just can't fix. The source highlights that traditional soda consumption has dropped 60% among Gen Z over the last decade.
60%?
Yeah, 60%. Gen Z inherently distrusts the chemical-laden, high-sugar profiles of those legacy products, but the mechanism driving this shift goes even deeper when you factor in the explosion of GLP-1 weight loss drugs.
Okay, walk me through how that actually works in terms of market demand. I know people on GLP-1s eat less overall, but does it really threaten entire legacy beverage empires?
It absolutely threatens their moat because GLP-1 medications target areas of the brain that regulate appetite and the physiological reward of food. Users literally stop getting the dopamine hit from a high-sugar soda.
Oh, wow.
Yeah, their cravings fundamentally change. The data shows that GLP-1 users heavily over-index on functional beverages like Olipop because they still want the physical, the behavioral habit of cracking open a cold can, but they want one that aligns with their new biochemical reality.
Right.
This is permanently rewiring market demand.
Which completely explains why Poppy, which is a direct competitor in this functional space, is reportedly being eyed for a nearly $2 billion acquisition by those legacy conglomerates.
Exactly. The old guard is desperately trying to buy their way into the new consumer reality.
But Goodwin is hinting he might take Olipop public via an IPO.
Yeah.
He doesn't want to be bought. He wants to be the acquirer.
Because he recognizes that legacy brands are bloated. They're losing their grip on the next generation. And if legacy consumer staples, which, make up a massive chunk of traditional index funds, if they are bleeding market share to functional startups, then institutional portfolios are incredibly vulnerable to these drop-offs in legacy stock values.
Okay, that raises a critical point for anyone managing money right now. If consumer behavior is shifting this radically under our feet, from bin stores to GLP-1s, how do institutional portfolios actually defend themselves? Because the capital has to go somewhere, but this transitional phase seems incredibly dangerous.
It is, and this is where we shift our focus to the 42 macro strategy source, because to understand how the smartest money in the room navigates these wild economic rewires, you really have to look at the mathematics of their risk management. Their entire philosophy is built around avoiding what statisticians call a type 2 error.
A type 2 error. Break that down for someone who didn't major in applied mathematics.
Fair enough. In statistics, a type 2 error is a false negative.
Okay.
It's when you look at a massive systemic risk and conclude, oh, it's nothing. You fail to see the danger that's right in front of you.
Right.
In institutional trading, a type 2 error translates to a career-ending, lifestyle-altering drawdown. It's stepping into a pothole so deep you can literally never climb back out.
And the 42 macro source specifically points out that the greatest investors, we're talking Warren Buffett, Stan Druckenmiller, Jim Simons, they do not try to pick exact market tops or exact market bottoms.
No, they don't.
But wait, I have to push back on that a little bit. Isn't the entire foundational premise of the stock market buy low, sell high? How can you generate massive wealth if you aren't trying to identify the bottom of a market crash?
Because trying to catch a falling knife based on intuition is a statistically losing game every time. When you try to pick an absolute bottom, you are guessing.
Yeah, that makes sense.
And smart money doesn't guess. They wait for mathematical confirmation. They wait for the trend to actually reverse, for volume to step in, and for the moving averages to align.
So they missed the very bottom.
Exactly. They willingly sacrifice the first 5 or 10% of a new bull run because waiting for that confirmation drastically reduces the probability of a type 2 error.
Because the math of a drawdown is just so brutal. Let's look at the actual numbers detailed in the source because they completely reframe how I think about a simple buy and hold strategy.
Yeah, the math is sobering.
It is. If your portfolio takes a 20% hit, you don't just need a 20% gain to recover. you need a 25% gain just to get back to zero.
And the calculus gets exponentially worse from there. A 30% drop requires a 43% gain. And if you suffer a 50% drawdown, which, let's remember, many retail investors did during the dot-com bust or the global financial crisis.
So yeah, a lot of people got wiped out.
Right. If you drop 50%, you have to achieve a 100% gain. You have to literally double your money just to get back to the starting line.
The dollar examples in the notes here are what really make it click for me. Say you have a $10 million portfolio. A 1% gain generates $100,000 in new wealth.
Right.
But if that portfolio falls into a 30% drawdown and drops to $7 million, that exact same 1% market move only generates $70,000.
Which is exactly why the singular goal of institutional risk management is compounding from a high net asset value. You must protect your high water mark at all costs. Because according to historical data going back to 1928, the S&P 500 spends roughly 25% of its time down 30% or more from its all-time highs.
Think about that for a second. A quarter of your investing life will be spent trapped in a massive drawdown if you just blindly buy and hold without actively managing your risk.
Yeah, it's a huge chunk of time.
And if you're listening to this and thinking, well, I don't day trade, what do I care about drawing down 30% for a few years? Here's why it matters to your 401k or your IRA. If that 25% chunk of time happens to align with the 5 years right before you plan to retire, your entire financial timeline is destroyed.
And that reality is exactly what is driving current institutional positioning. When we look at the Setup Sunday source, the one analyzing commitment of traders, or COT data, it tracks the commercial hedgers.
Right, the really big players.
Yes. And right now, commercial traders are actively reducing their net short positions on assets like Bitcoin and Ethereum.
Meaning they are taking off the downside protection. They don't feel the need to hedge against a crash in those specific assets.
Exactly. They are looking at the landscape, they're seeing the shifting consumer habits, the geopolitical noise, and they are quietly lifting their hedges. They are getting out of the way of what their models indicate is the next major momentum trend.
So, if the smart money is protecting their capital and waiting for mathematical confirmation, how does that translate to the actual live market price action today? Because the day trading transcripts we have from Vincent DeCiano's live session outline a market that is just incredibly fractured.
Fractured is definitely the right word. We're seeing a classic capital rotation, which basically means money is aggressively being pulled out of certain sectors to fund investments in others.
Yeah.
And to trade this safely, you have to identify what they call the no trade zones. The source outlines a very specific trap on the S&P 500 right now, situated between the 7632 and 7724 levels.
So explain the mechanics of a no trade zone for us. Why is it so dangerous to put capital to work between those two specific numbers?
So when the S&P is trapped between a previous major high and a major low, you aren't seeing retail traders exchanging shares. You are seeing billion-dollar algorithmic trading bots fighting over the exact same price points.
Just grinding it out.
Yeah. Taking a position in that zone isn't just choppy. It's like being in a rowboat caught between two battleships.
I love that analogy.
The algorithms will violently swing the price up and down. They're hunting for stop losses, liquidating weak positions, and there's zero clear directional trend.
So you are basically taking on massive risk for zero identifiable reward.
Precisely.
And the most dangerous traps right now seem to be in the semiconductor space. Ahead of NVIDIA's earnings, the broader semiconductor sector is completely disjointed from the rest of the market. Why aren't the massive AI expectations propping these stocks up?
Because institutional capital doesn't trade on hope. It trades on technical structures. And right now, the structures for legacy tech and semiconductors are showing massive downside vacuums. Specifically, what technicians call gap fills.
Okay, I love the concept of gap fills, but let's avoid the boring textbook definition. Let's use the ladder analogy from earlier. Walk us through how a gap fill actually functions in real time on a chart.
Sure. Imagine a stock's price history as a ladder. Normally, as a stock goes up or down, it steps on every single rung.
Makes sense.
But occasionally, massive overnight news hits, and the market skips 5 rungs entirely, opening way lower the next morning.
Leaving a hole.
Exactly. That empty space on the ladder is a gap, because no volume was traded in that space, no one built any structural support there, so it acts as a vacuum. Algorithmic trading bots actively hunt these vacuums because once the price slips back into that empty space, there's nothing to slow it down. The price plunges rapidly to fill in the missing rungs.
And we're staring down some massive missing rungs right now.
Hmm.
The QQQ, which tracks the NASDAQ 100, has a huge downside gap from 707.53 down to 71.59. And the SMH, the primary semiconductor ETF, is actively falling into a massive gap down at 545.46.
And the live trading transcript demonstrates exactly how violently these algorithms attack those gaps.
Oh yeah, it was wild to read.
The moment the NASDAQ failed to hold its morning support, it slid directly into that vacuum. It provided an incredibly fast, highly profitable shorting opportunity for day traders before finally finding support exactly at the bottom of the gap level. The bots literally pushed the price down to fill the missing rungs, and the moment the ladder was whole again, the selling just stopped.
It's so mechanical. But okay, if the broad index is a war zone between battleships and semiconductors are falling down open elevator shafts, where is all this capital actually rotating to? Where's the smart money deploying their high net asset value?
The rotation is aggressively targeting two specific sectors right now: software, which is tracked by the IGV ETF, and crypto.
Let's focus on software first. The notes highlight Palantir, ticker PLTR, as just a textbook technical setup.
Yeah, Palantir provided a perfect example of that algorithmic confirmation we talked about. It pushed up to test a previous major ceiling at the 176.50 level. In technical analysis, when a stock breaks through a hard ceiling and then successfully tests it from above, turning it into a concrete floor, it triggers massive institutional buying. But the real key for the day traders in the transcript was that Palantir successfully reclaimed VWAP.
VWAP, the volume-weighted average price. That term gets thrown around constantly in these trading rooms. Why is that specific line so crucial for a day trader?
Because VWAP is the grand equalizer. It calculates the average price a stock has traded at throughout the day, but it weighs that price by the actual volume of shares changing hands.
Right, so it factors in the heavy hitters.
Exactly. If a stock is trading above VWAP, it mathematically proves that the buyers are in absolute control of the heavy capital flow. Reclaiming VWAP at that 176.50 floor was the mathematical confirmation the 42 macro guys talk about. It proved the knife wasn't falling anymore.
That makes total sense. But as clean as that software setup was, the absolute flood of volume highlighted in the sources was pouring into crypto and its related equity proxies.
Oh, massive volume.
Yeah, Bitcoin pushed past major previous rejections, turning a heavy ceiling into a floor at the 75,230 level, which immediately puts the previous May highs of 83,900 right in the crosshairs. Ethereum is holding above 2,000, and Solana breached 80.
What's crucial here is how institutional traders actually play this momentum without necessarily holding the coins directly in their primary portfolios. They use highly liquid equity proxies, companies deeply tied to the crypto ecosystem.
Right, the sources highlight Circle bouncing perfectly off the 87 support level and BMR breaking out over a massive weekly resistance at 24.33. But the trade that really stood out to me, the one that perfectly marries the cold math of risk management with the brutal reality of human psychology, is the Robinhood setup. Ticker HOOD.
The technical framework on HOOD was pristine. It was attempting to establish a critical higher low between 106 and 108. The ultimate upside target was 120, which aligns with previous highs, and the trader in the transcript entered the position right as it reclaimed VWAP around 106.70.
And this is where the Type 2 error avoidance comes into play, right? The trader didn't just hope the stock would go up. He placed a hard stop loss tightly under VWAP. He rigidly defined his risk.
Yep.
The logic is simple. If the stock drops back below VWAP, the thesis is wrong, the buyers aren't in control, and you cut the position immediately to protect your capital. But if it holds VWAP, you stay in the trade.
And, building a mathematical plan is easy. Executing it while staring at a blinking screen, that is where most retail capital gets slaughtered.
Oh, the transcript captures this agony perfectly. The trader takes the HOOD position, the stop is set, and then time just drags.
It just grinds.
Yeah, the broader market looks terrible. The NASDAQ is testing its lows. Semiconductors are dumping. And this trader is just sitting in this Robinhood position up a tiny bit, watching the stock grind sideways for over an hour.
And that sideways grind, it is entirely designed to shake out impatient capital. Retail traders get bored. They look at the NASDAQ falling and they panic. They micromanage the trade, either taking a microscopic profit just to feel productive, or worse, they manually widen their stop loss because they don't want to admit they might be wrong.
Right, exposing themselves to catastrophic downside risk.
Exactly.
But the trader in our source does exactly what the 42 macro philosophy demands. He trusts the structural confirmation. He knows crypto volume is strong, he knows UD is defending that VWAP line, and he knows his risk is mathematically capped.
He literally says out loud on the transcript, this is the part of trading that sucks, just sitting here waiting.
But he doesn't touch the mouse. And eventually, the broader capital rotation floods into the sector, Hood aggressively pops, and he takes his $1,000 profit exactly at his 108 target.
It really is a masterclass in live fire risk management. He let the algorithm of his trading plan dictate his behavior, completely overriding his human anxiety. He protected his net asset value, he waited for confirmation, and he extracted his profit.
It is incredibly satisfying to see all these disparate data points locked together like this. We started a liquidator in New Jersey and see how inflation is forcing the middle class to dramatically alter their consumption, leaving corporate supply chains exposed.
Right.
We look at Olipop and realize Gen Z and GLP-1 users are structurally dismantling the revenue moats of legacy beverage empires.
And because those foundational consumer dollars are moving, the massive institutional capital that tracks corporate revenues has to rotate. But they don't gamble on the transition. They utilize rigid mathematics to avoid deep drawdowns, they step back from the chaotic S&P no-trade zones, and they let algorithmic gaps play out in dying tech sectors.
And when they finally strike, they do it with precision. They're targeting the VWAP reclaims in software and crypto proxies, where the new momentum is mathematically confirmed. It's just a deeply interconnected machine.
Which really leaves us with a critical paradigm shift to consider. Because we've established that younger generations are fundamentally abandoning legacy food and beverage brands, while retail and institutional capital is aggressively rotating into crypto assets and software rather than traditional mega-cap tech.
So what's the lingering question for our listeners today?
Well, if consumer behavior and capital allocation are both fundamentally rewiring at the generational level, are the traditional index benchmarks we rely on, like the S&P 500, actually masking a massive permanent structural shift in how smart money will define value over the next decade? Are the safety nets of the past 30 years becoming the hidden traps of the next 10?
Man, that is definitely something to think about the next time you blindly trust that simple green line on your screen. Thanks for diving deep with us today. Keep your subs tight, and we'll catch you on the next one.